So today we have Nick Simonetta, partner of SP Partners, joining us, and a little bit about Nick. So with more than 10 years of experience working in audit and advisory roles, Nick works with owner-managed businesses, not-for-profit organizations, and subsidiaries of multinational businesses. His industry experience includes professional service, retail distribution, not-for-profits, as well as financial service. Nick began his career with a multinational CPA firm, but moved to SP Partners to focus more on owner-managed businesses and not-for-profits to be able to provide accounting and assurance guidance within their budgets. So Nick is an assurance and advisory partner at SP Partners. And today, Nick is going to help us go through when to incorporate and why. Mm-hmm. So welcome, Nick.
Thank you so much for the introduction, and I'm happy to be here today. So the most common question I get asked from any person opening a business or even someone who's retiring is, should I incorporate, and why? And it's the first question you get asked from anyone who's self-employed, and whether they can save taxes by doing so. So my typical answer to that question is threefold. First, sometimes there's three reasons really to incorporate from my perspective. Sometimes you have to. You have a major customer who just wants to deal with a corporation and doesn't want to deal with an individual for liability purposes, and they prefer to deal with a corporation. In that sense, you have no other choice but to incorporate. The second reason is for liability purposes. Although I'm not a lawyer, if you have some significant personal assets and you're running a business personally, those personal assets are certainly there's a potential that if there's a lawsuit for whatever reason, that those are on the table in that lawsuit. And so incorporating could split off your personal assets from your corporate assets and creditor proof those personal assets, including your personal home. So that's the second reason. And of course, ideally, if you're going to save taxes, the small business rate is about 12.25% these days in Ontario. Okay. And the highest marginal personal tax rate is 50%. So if you do the math, there's a significant tax savings if you're earning income and you don't need all that income that you're earning to live off of. So the advice I give to the new clients, new business owners that come in here is do a budget, see how much you need to live off of. If your business is bringing in more money than you need to live off of, then it's probably worth incorporating from a tax perspective, if not from a liability perspective. So, those are really the three reasons that I've come across in my career as to why someone might consider incorporating and why they probably might should. So, the short answer is it really depends on your personal situation as to whether you incorporate or run the business as a sole proprietorship. But you should speak to a person like me to figure out whether it makes sense for you.
Right. Okay. That makes sense. So you did kind of answer this as to when you should start to speak to someone about incorporating, but is there ever too soon to talk to a trusted advisor?
No, it's never too soon. It's never too late to talk to your accountant, your lawyer. A lot of the people that are sent to me to talk about this come from lawyers or are referrals from our current clients. They come to us and say, "Hey, this is my scenario. Should I be incorporated?" People have run their business years as self-employed individuals. Mm-hmm. Should I be incorporated? What's the tax savings? And you can show them the tax savings, and sometimes it makes a lot of economical sense or tax sense to do it. So, and I should just clarify, when we're talking about tax savings, it's actually a tax deferral, because eventually you'll take the money out and pay tax on it, but there's a significant tax deferral when you're looking at the top marginal rate of 53.53% versus 12%.
Right. And can you explain what a typical share structure would look like when you incorporate?
Yeah, so the most simple share structure is, Brittany, you have a business, you incorporate, and you own 100% of the common shares of that business.
Okay.
when you have a spouse, it gets a bit more complicated. If the spouse is active in the business, we might consider having the spouse have shares as well.
Right.
Especially if she's doing more than 20 hours a week for splitting the income between you and your spouse. So it really, again, it depends on your situation, but there's a simple and there's a bit more complex structure. It also depends on your age. If you're older, 65 and older, and you've got a corporation, you might want to include your spouse so that you can, within the TOSI rules, split income between your spouse. So
Okay, that's good to know. And what should I expect after I incorporate?
So you need to remember that the money that's in the corporation after you incorporate isn't yours, it's the corporate money.
Right.
And so there's this account for bookkeeping purposes called the shareholder account that keeps track of how much money you've put into the business and how much money you've taken out.
Okay.
And from a tax perspective, if you've taken out money from the business and not repaid it, it's considered a benefit and you should be paying tax on it. So you need to consider that accounting. The bookkeeping for your corporation, you need to have, completely separate transactions, separate bank accounts, separate credit cards for your business. It's your corporation, but it's not your money.
Right.
And so unless you're willing to pay tax on the money that you're taking out, then you should refrain from using it as your own personal bank account. Personal expenses should be completely and excluded from the business.
Right. Now, does this differ if you are a sole proprietor?
It can differ significantly, simply because when you're a sole proprietor, there's no you're not borrowing the money from a separate legal entity. You are the owner,
right?
And you're going to pay tax on 100% of the income that you report on your self-employment income and report on your tax return. Whereas when you have a corporation, the corporation is going to pay its tax bill, and you're going to pay your tax bill separately, and you're going to pay tax on the money that you've taken out of the business only.
Right.
And the corporation is going to pay its 12.25% on the income that it's earned in the business.
Right. Now, as a sole proprietor deciding to maybe become a corporation, is there anything you should do prior, like in terms of setting up your accounts, or can that all be completed afterwards?
So I highly recommend talking to your accountant, talking to your lawyer, and talking to the person, your contact at your bank. Ideally, what's going to happen is there's going to be an incorporation process with the lawyer. There's going to be some collaboration between the accountant and the lawyer on the share structures, what shares the corporation can authorize and what shares are going to be authorized, and the attributes of those shares. And then there's going to be a discussion with your bank on how to get the accounts where you've had that money as a sole proprietor moved into a business account, and any business, and also authorization of any new credit cards for the business in the business name.
Right. Okay, that makes sense. And so you just kind of answered this, but you need to have a bank account for a corporation that's separate.
Yeah, so completely separate and distinct from yours. It's got to be in the corporation's name, not in your name.
Right.
And you should have credit cards in the corporation's name if you're going to, and use those credit cards for business transactions. Don't use the business credit card for personal transactions. Use your own personal credit card.
Do you find that happens sometimes with smaller businesses?
Absolutely. You go to the store to buy supplies, and you pull out the first credit card from your wallet that you have.
Yeah.
And usually, sometimes it's your personal credit card, and you end up spending your personal money on a business expense, and sometimes it's your business credit card and you're using it for a personal expense. And so it's very important that you're making sure that if you're going to the store to buy supplies online or in person for your business, that you've got that business credit card and you're using that and not your personal, and vice versa.
Right. I can see how easy it would be to make that mistake. It's just sometimes you want to just get something paid more quickly, but best practice, right? So on this subject, how would I maintain my accounting records for my new business?
Yeah, it's very important to maintain your bookkeeping records and make sure that they're accurate. The simplest form would be to use an Excel.
Okay.
But I would suggest using bookkeeping software like QuickBooks Online. It's the most widely used QuickBooks bookkeeping software in the world. You can link your bank accounts and your credit cards
Really?
so it pulls in the transactions, and at that point, it's a matter of just classifying what the transactions are. So I think it's meant to be user friendly.
Yeah.
It's meant to be used by non-accountants, but at the same time, if you need help, contact your accountant. We can do a Teams call online and we can walk you through how to do certain transactions.
Awesome. So aside from corporate tax, what other taxes should a newly incorporated business think about?
Yeah, so if you have employees, there's going to be payroll taxes and remittances and T4s that you're going to have to file with the government each year. So those employment taxes, the CPP, the EI, and the income tax withholdings, remittances, usually monthly, the 15th of the following month. And then the next biggest tax is HST,
Right.
I usually, there's a $30,000 threshold in terms of revenues once you're automatically registered once you hit that 30,000. If a business owner thinks they're going to hit that 30,000, and usually they do, I recommend that they register right away, and they can start claiming the HST that they paid, but then they would also have to charge HST to their customers.
And can all this be done like online through CRA?
So the filing's done online. Your bookkeeping, this is why bookkeeping is so important, keeps track of how much you've paid and how much you've collected in HST.
Okay.
And QuickBooks actually has a report in it, a sales tax report that generates basically what the HST return will look like.
Oh, wow.
And as long as that's accurate, you're going to file based on that return. And you can file that through CRA online as long as you have a My Business account. Or once you register for so once you incorporate, you'll get a letter from the CRA. The CRA will ask you if you want to register for HST in that letter. You call the number that's on that letter, and they will set you up with an HST account.
Okay.
And then once you have that HST account, you'll get a letter from them with a 4-digit number, and you can file through NetFile using that 4-digit number.
Okay. So besides your T2, your HST, your payroll, that's all on the newly incorporated business or any incorporated business to file on behalf of themselves.
It's to file on behalf of themselves, and then you also, depending on what industry, and you have to consider WSIB as well.
Right. Okay. Okay. So now I think the most important question that any business owner would be considering, how do I compensate myself?
Yeah, so there's really two mechanisms for you to consider when you're deciding how you're going to get the money from the separate corporate legal entity to into your individual hands. So we talked about a budget earlier. So, you need $70,000 to live on every year. So you pay yourself $70,000 salary, right?
Right.
So really, you can take that through a dividend. So a dividend is what's considered a return on your equity.
Okay.
It's not deductible to the corporation, so there's no tax deduction. And it is taxable to you through a T5. So T5 would be issued, and it would be on your personal tax return as a return of equity. It's not considered earned income for the purposes of calculating RSP contribution room. The other option is to pay yourself a salary.
Okay.
$70,000 salary. You, tranche that out over 12 months, and then you pay the remittances each month. So you're paying the taxes and you're paying CPP. Self-employed individuals are exempt from EI.
Okay.
As long as you're a controlling shareholder of the business. And so you would make those payments, and then at the end of the year you'd get a T4, just like you would if you were an employee somewhere else, and you'd report the T4 income. T4 income is considered earned income for CPP for RSP contribution purposes. It also, you're contributing to CPP every time you get a employment income, whereas when you have dividend income, you're not contributing to CPP. So I usually recommend to my clients, if the cash flow is available in the business, to pay themselves at least $80,000 of salary.
Okay.
And then after that, you're sort of indifferent, because the tax the tax integration works so that once the benefits of you contributing to your RSP or topping up your RSP contribution room and your CPP contribution room are done, then you're indifferent to taking dividends and salary.
Right. So just for my understanding, so you could take salary and then pay yourself a dividend later on?
So you could take $80,000 of salary and then take an additional $50,000 of dividends.
Right.
And so you could do that combination, and
Okay.
it would do a couple things. So let's just take the example where you only pay yourself a dividend, and let's say you're 30 years old, and every year you pay yourself just a dividend. So first of all, there's no tax planning with respect to your on your personal taxes as it pertains to RSP contributions, because you're going to lose. You're not going to gain any RSP contribution room.
Right.
You're going to stop contributing to CPP. So when you retire at the age of 65 or whenever you retire,
Right.
your payments are going to be a lot lower, if anything.
Right.
And so those are the biggest advantages of at least taking some salary when you're self-employed, when you're running your own business.
Right. Yeah.
And then after that, you pay yourself a dividend. And really, when you look at the integration, so the tax at the corporate level and the tax at the personal level, you're indifferent to those things.
Right. So, question. You've started your corporation, you've paid yourself now, and now you have some leftover, like retained earnings left into that account. What do you do with it? Do you keep it in your business, or at that point, do you want to?
Well, it's good to keep retained earnings in your business. That means you've made profit and you haven't taken all the money out. That's the whole idea of the tax deferral and the benefits from a tax perspective of having the corporation. Right?
Okay.
If you take all the money out, again, the tax integration rules work that you're going to pay your 12% in the corporation, but then you're also going to pay the tax on the full amount at the potentially the highest marginal tax level.
Right.
Right. So ideally, you want to leave retained earnings and you want to leave cash in the business. First of all, you want to reinvest in the business because you want it to grow, but you also want to defer those taxes down the road.
Right. And so when you're deferring your taxes, is it because you would be waiting till you're going to sell your business later on, or is it retirement? Is that part of your tax planning strategy?
So yes, so it's essentially you're putting the money away for your own it's a private pension plan for yourself.
Right. Okay.
So there's other structures that can be put into place to what they call purify your operation, your opco. But just to keep things simple, you'd essentially accumulate that cash in your business right now, with the expectation that one day you'll have a structure in place that will pull that money to a corporation that you'll be able to accumulate, invest those funds, and grow a portfolio, have a return on your investment, and basically create a retirement fund for yourself.
Right. Okay, that makes sense. So are there any other tips or considerations when starting to incorporate or looking to incorporate?
Yeah, I mean, I think your first consideration is to talk to your accountant, see if it makes sense to incorporate from a tax perspective, see if it makes sense, speak to your lawyer, see if it makes sense from a liability perspective. I typically see individuals who are self-employed who have significant personal assets running a business, and as long as you have an employee, there's a significant liability there where you could be sued for wrongful dismissal, and if your business doesn't have the cash, certainly your personal assets are at stake.
Right. Okay. Well, I think that's all my questions for today. So thank you, Nick. Appreciate your time.
Thank you for having me.